Hi guys, Ben here and welcome to Motivation to Invest. The legendary billionaire investor Warren Buffett once stated if he was managing just $1 million or less, he could compound this at an incredible 50% per year consistently. As you may be aware, Warren Buffett manages billions and billions of dollars via the world's largest investing conglomerate, Berkshire Hathaway. As the investment manager of Berkshire Hathaway, that comes with a lot of responsibilities. Thus, Warren Buffett cannot be as nimble and as fast when investing. So how could Buffett achieve this 50% return if he only had $1 million or less, or started with a small sum of money like me or you guys?
But you indicated, you're quoted in the local paper as saying that you are confident that if you were working with a sum closer to $1 million, that you could compound that at a 50% rate. For those of us who aren't saddled with the $100 billion problem, could you talk about what types of investments you'd be looking at and where in today's market you think significant inefficiencies exist? Thank you.
Yeah, I think I may have been very slightly misquoted, but I certainly said something to the effect. It is true. I think I can name a half a dozen people that I think could compound $1 million, or at least they could earn 50% a year on $1 million, have that as an expectation. If they needed it, I mean, they'd have to get their full attention to be working on the sum. And those people could not compound money, 100 million or $1 billion, at anything remotely like that rate. I mean, there are little tiny areas which, if you follow what I said on the screen there on that Adam Smith's interview a few years ago, if you start with A and you go through and you look at everything and you find small securities in your area of competence that you can understand the business, I think you can, and occasionally find little arbitrage situations or little wrinkles here and there in the market. I think working with a very small sum, that there is an opportunity to earn very high returns, but that advantage disappears very rapidly as the money compounds. Because from $1 million to 10 million, I would say it would fall off dramatically in terms of the expectable rate. Because there are little, you find very, very small things that you can make, and you're almost certain to make high returns on, but you don't find very big things in that category today. I'll leave to you the fun of finding them yourselves. I mean, it'd be terrible to spoil the treasure hunt. And the truth is, I don't look for them anymore. Every now and then, I'll stumble into something just by accident. But I'm not in the business of looking for that. I'm looking for things that Berkshire could put its money in, and that rules out all of that sort of thing.
So Buffett stated he could achieve this by investing into small cap companies in his circle of competence. So a circle of competence is an area which you know about. So this could be job related, it could be experience related, it even could be some sort of information edge. For example, you could be a consumer of a certain product or service which may be very niche and not many people on Wall Street know about it. Now, Warren Buffett doesn't just talk the talk, and he actually used to walk the walk, especially when it came to smaller cap companies. So Berkshire Hathaway actually bought See's Candy for just $25 million in 1972. Now, that was for the whole company. Now, in that year, it had roughly $30 million in sales. So Buffett actually purchased See's Candy for less than the company's sales, which is an incredible price to sales ratio. At that time, the company was also bringing in $4.2 million in profit. Then in 2007, sales had risen nearly 13 times to stand at $383 million. Even more impressive, Buffett revealed profits which were up nearly 20 times and stood at $82 million. That means Warren Buffett and Berkshire Hathaway now earns more than 3 times the original investment amount each and every year from See's Candy.
Excellent.
So the real question is, should you guys invest into small cap stocks if they're so fantastic? And why doesn't everyone just invest into small cap stocks? Why don't we see these big Wall Street institutions just investing into small cap stocks? Well, in this video, we're going to find out, as I'm going to deep dive into a comparison between small cap stocks and large cap stocks to see which is the best for us as investors to start growing a small sum of money. Because I've had many of you guys message me and you've actually said, Ben, how can I grow a small sum of money? I've got $1,000, I've got $2,000, I've got $5,000, I've got $10,000. How can I grow this small amount to achieve massive returns? Should I be investing into large, safe companies, or should I be investing into smaller cap companies with higher returns? But before we dive in, if you're new around here, then why not join the investing family by hitting that subscribe button and turning that notification bell on. That way you'll get notified when I'm releasing new investing tips and exclusive stock market picks, which I'm personally investing into. Feel free also to check out the first link in the description if you want more details on the VIP membership group. This is an exclusive group in which I reveal my buy and sell signals. So when I'm making my moves, you can make your moves. In addition, I reveal all the stocks and the story of my 6-figure portfolio, how I built the portfolio, my strategies, my principles, and all the stocks in it. Now there'll be more on that at the end of the video, so be sure you guys watch till the end. But with that being said, let's dive in. So firstly, what are small cap stocks and large cap stocks? Because that may be quite a confusing term for some people. So small cap is basically an abbreviation for small capitalization, and large cap is an abbreviation for large capitalization. Now, market cap of the company is basically the stock market value of that company, the size of the company. Now, to calculate the market cap of the company, you take the number of shares outstanding and you multiply that by the current share price, and that gives you the market cap. But luckily, most stock screeners will just show you this market cap, so you don't need to calculate it. For example, the giant Amazon has a market cap of $1.58 trillion. And I actually did a video on how big can Amazon grow, so be sure to watch that video. I really did dive deep into that company because it's a fantastic company, but despite its size, can it still keep on growing at the same rate? Here's an example of a smaller cap company which I actually recommended on this channel before it skyrocketed. So Upwork, this is a stock which is part of the gig economy. So it's a platform for freelancers, basically. I did recommend the stock a few months back, and as you can see here, it was around $20 per share, and now it's shot up by over 78% in just a few months. Now the market cap of this company right now is only $4.36 billion. So it has plenty of room, it has plenty of runway to continually growing. And that is the power of small cap companies. And there's also Fiverr, which is a platform for freelancers, and that was a similar story. So it currently only has a $7.25 billion market cap. The share price was around $25 per share. However, it's since skyrocketed by over 700% this year. Now, a company such as Amazon, Google, Alphabet, Facebook, although they're exceptional companies, there's no way that they could skyrocket by 700%. It's just economically impossible. But that's the power of small cap companies. So congratulations to everybody who got in on those stocks.
Buy low, sell high, that's my motto. I may just quit my job at the power plant and become a full-time stock market guy.
But there are many more examples which I've revealed on this channel, so stay tuned. Now, for an exact definition of small cap and big cap stocks, I've dived in to Investopedia. Here we can see big cap stocks are large and have a market cap of $10 billion or more. Small cap stocks generally have a market cap of $300 billion to $2 billion and have been known to outperform their large cap peers, which we're going to discuss in a minute. Now, small cap stocks should not be confused with risky startup companies. That is a completely different ballgame, and I'll be discussing that in a future video. Now, I've split this comparison between small cap stocks and large cap stocks into 4 main criteria. That is performance, liquidity, volatility, and risk. So let's dive into each one of those right now. So diving into the performance, I've got a comparison chart up here between the Russell 2000 index, which is a small cap stock market index of the smallest 2,000 stocks in the Russell 3000 index. Now, I've done a comparison between an ETF tracking that index and one tracking the S&P 500. So that's the 500 largest and best performing companies in the US stock market. So over a 10-year period, so I've done it from the year 2000, the small cap stocks are in red and the larger cap stocks, the S&P 500 index, is in the blue. And as you can see here, the red has consistently outperformed the blue in terms of returns. Even the drop in March, it was still above the S&P 500. So the total returns, this is over a 10-year period, is 316%. And for the S&P 500, we have 167%. Now that's what's been calculated here. It's probably actually more than that. So that's performance. However, we have seen the S&P 500 slightly outperform the smaller cap stocks in the past maybe 6 months to a year due to the major tech giants. But to keep things simple, over the past 10 years, in general, small cap stocks outperform large cap stocks. That's just an historic fact. So small cap stocks seem incredible. You get greater returns. So why don't we just all invest into small cap stocks? Well, there are a few issues which I'm going to discuss in these other categories. So the second comparison category is liquidity. So liquidity is how easy you can buy and sell a stock. Now, if I explain liquidity with other assets, so property or real estate, that's an asset with low liquidity. It's very difficult to buy and sell a property. It can take a long period of time. There's lots of paperwork. It can be very time consuming and costly to buy or sell a property, whereas stocks are a lot more liquid. However, larger cap stocks tend to be more liquid as there's more shares outstanding, there's more buyers and sellers, and there's more action in the marketplace. Whereas smaller cap stocks, more obscure stocks, there might not be as many people active buying and selling these stocks, and there's less shares outstanding. Now that can add a risk when investing, and is actually why many large institutional investors don't invest into small cap stocks, because they've got billions and billions of dollars to deploy. The company might only have a market cap of $2 billion, and there may only be a few $1 million worth of shares trading each and every day. So in order to build up a very large position, it may take a significant period of time. We see this a lot with Ark Invest and Cathie Wood. So they do invest into quite a few small cap stocks, but they can't just invest into them all in one go. So what they do is build up the position over a period of time, and they actually track their trades, so be sure to stay tuned for that. So category number 3 is volatility. Now I always say this, risk is not volatility. That is a great quote by the value investor Seth Klarman, who's been called the next Warren Buffett. But volatility can still be pretty scary, guys. Now, small caps tend to be more volatile, in which they tend to have high upswings, but also high downswings. So you could invest into a stock, it might drop 30% in a day, it might increase 50% in a day. This is what you can get with a small cap stock. So you have to watch your money decrease by, say, half, and then increase by double within a few days. So it's a very wild ride when investing into small cap stocks. Thus, the perceived risk is higher with small cap stocks. And that brings me on to the final category, category number 4, which is risk. Now, risk is not volatility. Risk is the likelihood of losing your initial investment. Now, firstly, as it's a small cap company, it may not have a long track record of growth. So let's say the company has a faulty business model, or a business model which has only been working in the short term or due to some very specific circumstances. Now, because the company hasn't been around for such a long time, it's difficult to track the data coming from that stock. In addition, small cap companies usually have less access to new capital and new sources of financing. Thus, due to this reason, it's more likely that the company will not be able to bridge the gaps in its cash flows or expand the business because of the inability to undertake the necessary investments. You may have heard the phrase before, they're too big to fail. Now, some large cap companies are so big, so massive, so ubiquitous that the government just wouldn't allow them to fail. An example of this is the big banks during the financial crisis. But the smaller companies, no problem. Governments will allow them to fail any day of the week because they don't employ thousands and thousands and thousands of people, and it wouldn't put their livelihoods at risk, which would put strain on the government. So small cap stocks can be more risky in that sense. Now, another risk with small cap stocks could be profitability. So let's say it's a small growth company. They're reinvesting all their profits in order to grow the business. That is a great strategy and it can work for many companies, but it's also a very risky strategy because if this company does not have positive free cash flow, does not have profits coming in, then it adds a greater risk for investors of share dilution. This is another reason why many institutional investors actually have strict rules and criteria which say they're not allowed to invest into any company with negative cash flow or that's unprofitable. Now, despite the issues with small cap stocks, it's been proven historically with the data that small cap stocks outperform large cap stocks. And you may have heard the phrase elephants don't gallop, and this is because larger cap companies tend to not move as fast as smaller caps. So why doesn't everybody just invest into small cap stocks? Well, due to the aforementioned issues, many analysts stay away from these stocks, and because there's less coverage on these stocks, there's less mainstream news on these stocks, people just don't know about a lot of the great small cap stocks. It's quite difficult to find out the information for which are the greatest small cap stocks, which are these hidden gems which you guys can invest in and 10x your money. However, I do have a solution for you guys because I'm all about solutions. I'm not one of these YouTube channels which will present you all the data and then just say, okay, have a nice day. I'll actually try and give you a solution. So the solution is this community right here, Motivation to Invest. So if you haven't subscribed already, feel free to hit that subscribe button. But the Motivation to Invest community, we are dedicated to helping you guys achieve great financial returns by investing into stocks. I invest my own money into these stocks. I research these stocks each and every day, and I've produced over 250 videos on investing for you guys. But that's not all. There's also the VIP membership group. This is when I can go a little bit deeper. I can go into technical analysis of stocks. I can post exactly when I'm buying and selling stocks. So when I make my moves, you can make your moves. I also give you guys access to my 6-figure portfolio, the stocks and the story of how I built that portfolio from just $20,000 to over $200,000. But that's not all. You also get access to lots of exclusive content, such as our private members chat on Discord. So on Discord, this is a like-minded group of people, and we all discuss different investing topics and ideas. There's a lot of exciting information on there, and it's all like-minded people moving towards a successful point in their lives. Now, the reason I set up this group was after many requests from you guys, as sometimes by the time I get a video out to you guys, a stock may have already ran up. Or if I spot one day that a company's fundamentals have changed and I'm selling fast, you guys won't be aware until a few days later, as it takes a long time to edit these videos. Now, if you're interested in joining the VIP membership community, or you're just curious, then I've actually made a full video outlining the different tiers and packages on Patreon. So you can click the first link in the description, it will take you to Patreon, you can watch the video and just see if it's right for you. The cost of the membership is the price of a coffee, and I personally think the amount of value you get is absolutely incredible. With that being said, if you guys found some value in this video, then feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. With that being said, I hope you guys have an incredible day, and I'll see you on the other side. Invest safe.